Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Welcome to the Mayor Brown Global Financial Markets Podcast. Today's topic is the recently finalized rulemaking implementing the Community Reinvestment Act. The FDIC, Federal Reserve, and OCC issued a final rule in October 2023. We will provide a brief summary of the rulemaking process, discuss the final rule's major provisions, and highlight some key takeaways and first steps for banks. My name is Kris Kully. I am in Mayor Brown's Washington, D.C. office and a member of the firm's Financial Services Regulatory and Enforcement Group. My co-presenters today are my colleagues Jeff Taft and Kerri Webb, also members of our Financial Services Regulatory and Enforcement Group here in Washington. Let's jump right in. The Community Reinvestment Act, or CRA, was enacted in 1977 to encourage banks to help meet the credit needs of the communities in which they operate, including low and moderate income neighborhoods. The CRA requires the banking agencies to assess the extent to which the banks are meeting those needs and to consider that assessment when evaluating applications for charters, mergers and acquisitions, and branch openings or relocations. The agencies generally publish advance notice of CRA examinations to allow the public to comment on banks' performance. The CRA and its implementing regulations provide a framework of categories, tests, benchmarks, and processes to measure banks' community lending and other activities. The banking agencies issued the first set of CRA regulations in 1978 and significantly revised them in 1995 and addressed them again in 2005. You may recall some more recent activity. In January 2020, the FDIC and OCC issued a proposed rule, and in May 2020, the OCC unilaterally issued, but then rescinded, a final rule. The Federal Reserve, for its part, issued an advance notice of proposed rulemaking in October 2020. However, after those separate efforts, the three agencies announced their commitment to work together in order to provide a consistent framework across all applicable depository institutions. The three agencies issued a joint proposed rule in June 2022, and as I mentioned, they issued the final rule in October 2023. The final rule has a multi-year phase-in period, although some aspects kick in next year, which we will address in a bit. With that background, let's move into the final rule's provisions. As under the current CRA regulations, the agencies will continue to apply different performance tests depending on a bank's asset size. The biggest changes under the final rule are in store for large banks. The changes under the final rule are more moderate for intermediate banks, and there are fewer changes for small banks unless they opt in. Under the final rule, banks are classified based on their assets as of December 31st in the prior 2 calendar years. Under the final rule, a large bank is one with assets of at least $2 billion as of December 31st in both of the 2 prior calendar years. Intermediate banks are those with assets of at least $600 million and less than $2 billion. Small banks are those with assets of less than $600 million. These asset size thresholds will be adjusted annually for inflation. The bank size dictates the tests against which the banks will be measured. My colleague Jeff will provide more information about all the different tests in just a bit. But to summarize, large banks, again, those with $2 billion or more in assets, will be evaluated under 4 different tests. Large banks will be subject to a new retail lending test, a retail services and products test, a community development financing test, and a community development services test. Actually, I should note that extra large banks, those with assets greater than $10 billion, will also be evaluated specially in connection with their branches, remote service facilities, and digital delivery systems. But again, we'll dig further into the tests in just a bit. Intermediate banks, again, those with assets of at least 600 million, but less than 2 billion, will be evaluated under the new retail lending test and under either the intermediate bank community development test or at the bank's option, the new community development financing test. Small banks, those with assets of less than 600 million, will be evaluated under the small bank lending test or at the bank's option, the new retail lending test. Limited purpose banks, now defined to include wholesale banks, which have been eliminated as a separate category, will be evaluated under a modified community development financing test for limited purpose banks. Banks of all sizes may still request an evaluation under an approved strategic plan. The final rule now provides some additional clarity and flexibility from the proposed rule on how banks can develop a strategic plan, although this option remains subject to community engagement and regulatory approval requirements. Now that we've run quickly through the bank size categories and the tests under which agencies will evaluate those banks, let's talk about the final rule's geographic assessment areas. Geographic assessment areas remain the cornerstone of the CRA. Where, actually, will a bank's performance be evaluated? The Act provides generally that banks must serve their, quote, entire community. In the new final rule, the agencies revised the current assessment area framework by requiring all evaluated banks to continue to delineate facility-based assessment areas and requiring large banks to delineate a new area referred to as retail lending assessment areas. I'll add here that the huge rule may seem pretty overwhelming. One tip I've heard is to turn first to the actual regulatory language. With that in mind, I'll provide the section numbers for the codification of the assessment areas. You may want to start there. Okay, first we'll start with the facility-based assessment areas. These areas are addressed in section 16 of the rule. A bank must delineate one or more facility-based assessment areas within which the agency will evaluate the bank's record of helping to meet the credit needs of its community. Under the rule, a facility-based assessment area is generally a county-based area. So a metropolitan statistical area, MSA, may include several counties. So as such, there would be multiple facility-based assessment areas. A bank's facility-based assessment areas must include each county in which a bank has a main office, a branch, or a deposit-taking remote service facility, as well as the surrounding counties in which the bank has originated or purchased a substantial portion of its loans. However, an intermediate bank or a small bank may adjust the boundaries of its facility-based assessment areas to include only the portion of a county that it reasonably can be expected to serve. An area that includes a partial county must still consist of contiguous whole census tracts. A bank's facility-based assessment area must not reflect illegal discrimination and may not arbitrarily exclude low or moderate income census tracts. However, the agencies decline to define when such an arbitrary exclusion takes place. The next assessment area I'll address is new. It is the retail lending assessment areas addressed in section 17 of the rule. A large bank must delineate retail lending assessment areas within which the agency evaluates the bank's record of helping to meet the credit needs of its entire community. However, one new aspect of the final rule, as compared to the proposed rule, is that a large bank is not required to delineate retail lending assessment areas for a particular calendar year if, in the prior 2 calendar years, the large bank originated or purchased within its facility-based assessment areas more than 80% of its home mortgage loans, multifamily loans, small business loans, small farm loans, and automobile loans, if automobile loans are a product line for the large bank. This 80% will be measured based on a combination of loan dollars and loan count. Specifically, those two percentages will be averaged to determine whether there is an 80% overlap. In other words, if a bank is a largely facility-based bank, such that it largely provides retail lending products in the same geographies as where its facilities are located, then it will not be required to delineate a separate retail lending assessment area. This area is intended to be largely separate and distinct from a bank's facility-based assessment area, recognizing that some banks have largely non-branch-based delivery channels. Let's talk about the geography of a retail lending assessment area. For a large bank, such an area must consist of either the entirety of a single MSA, excluding any counties inside the bank's facility-based assessment areas, or all of the counties in the non-metropolitan area of a state, excluding any counties included in the large bank's facility-based assessment areas, and any counties in which the large bank did not originate any closed-end home mortgage loans or small business loans that are reported loans during that calendar year. A retail lending assessment area may not extend beyond a state boundary unless the retail lending assessment area consists of counties in a multi-state MSA. However, these areas may also be trimmed back based on a large bank's product lines during the calendar year. If there is an area, an MSA, or a county in a non-metropolitan area in which the large bank did not originate or purchase any reported loans in any of those product lines in a calendar year, then the agency will not consider that area to have been delineated as a retail lending assessment area for that calendar year. In addition, these areas may be trimmed back based on the large bank's volume of certain types of loans, namely closed-end home mortgage loans or small business loans. If the large bank did not originate at least 150 closed-end home mortgage loans or 400 small business loans in an area in each of the prior 2 calendar years, then the large bank is not required to delineate that area as a retail lending assessment area. Those loan count thresholds were raised in the final rule as compared to the proposal. The agencies estimate that will cut in half the number of banks and assessment areas to which this retail lending evaluation will apply. The next geographic assessment area we'll address is the outside retail lending assessment area. This is in Section 18 of the rule. The retail lending performance of large banks and certain intermediate banks and certain opt-in small banks will be evaluated in their outside retail lending areas. These are areas that are outside the bank's facility-based and retail lending assessment areas, including in certain non-metropolitan counties. Evaluation of intermediate banks in their outside retail lending areas is mandatory if the intermediate bank conducts a majority of its retail lending outside of its facility-based assessment areas. This outside retail lending assessment area will allow the agencies to evaluate a bank's retail lending that is too dispersed to be evaluated within a specific geographic area or that does not meet the lending thresholds described above. The agencies hope this assessment will aid in recognizing the expanded role of mobile and online banking. In a change from the proposed rule, the final rule adjusts the standard used to determine when an intermediate bank's outside retail lending area is evaluated on a mandatory basis and applies the same standard to a small bank that opts to be evaluated under the retail lending test. It permits an intermediate or small bank that does not meet this standard to opt to have its outside retail lending area evaluated, and it tailors the proposed geographic standard for outside retail lending areas to exclude those non-metropolitan counties in which a bank did not originate or purchase any closed-end home mortgage loans, small business loans, small farm loans, or automobile loans if automobile loans are a product line for the bank. So that's a rundown of the geographic assessment areas under the final rule. Now I'll hand it over to Jeff to dig into the tests themselves.
Thanks, Kris. I appreciate it. A lot to go over here, and I'm going to try to go through the tests at a relatively high level. Obviously, these are important, but they're also very detailed. So let me just start by kind of giving us the lay of the land. I mean, under the existing CRA rule, evaluations are based on lending, investment, and services tests for most banks. The final rule revises the existing tests and creates new ones to replace those under the current CRA regulations. Under the final rule, large banks' engagements with LMI, individuals and communities, small businesses, and small farms will be measured using the 4 tests that Kris has outlined. Let me start off by talking about the retail lending test, which is really the lending test that's the most important aspect of the CRA assessment process. The final rule revises the existing lending tests to evaluate how banks are serving LMI borrowers, small businesses, and small farms in their facility-based assessment areas and, as applicable for certain large banks and intermediate banks, in their retail assessment areas and outside retail lending areas. The test includes 2 sets of metrics that I want to just talk about briefly. First, the retail lending volume screen measures the volume of a bank's lending relative to its deposit base in its facility-based assessment areas and compares that ratio to the aggregate ratio for all reporting banks in the same facilities-based lending area. That's basically how you're performing in areas where you have basically branches and locations. Second, the agencies will evaluate the geographic distribution and borrower distribution of a bank's major product lines in all assessment areas using a series of metrics and benchmarks. In response to comments on the proposed rule, the final rule adjusted some of the performance multipliers to make favorable performance conclusions more attainable for lenders. The final rule also reduces the number of evaluated product lines from 6, as proposed, to 3 for most banks. These 3 product lines are, first, closed-end mortgage loans, second, small business loans, and third, small farm loans. These are really the traditional CRA-related loan products that have been monitored for years under the rules. The final rule also requires evaluation of a bank's automobile loans if such loans represent a majority of the bank's retail lending. And when I say a majority, I mean more than 50% of the bank's retail lending consists of auto loan purchases or originations, or it can also be included at the bank's option. So for banks, obviously, that have a large part of their portfolio in auto lending, they will be automatically included, but other banks can include it at their option if they desire to have that included as part of their evaluation in the retail lending test. Let's talk a little bit about the retail services and products test. For large banks, this is a new test that evaluates the availability of a bank's retail banking services and retail banking products, as well as the responsiveness of those services and products to LMI communities, small businesses, and small farms, including for some banks, the availability of digital or other delivery systems. This test is largely unchanged from the proposed rule, although it includes some adjustments, including incorporating benchmarks to evaluate the availability of a bank's branch and remote facilities. Another key change for the proposed rule is that the responsiveness portion of the test will only positively contribute to a bank's rating, so it can't have a negative impact on the bank's ratings. For large banks with assets less than $10 billion, the agencies will not evaluate the availability and usage of responsive deposit products except at the bank's option. The third test is the Community Development Financing Test. This test will combine the current evaluation of community development loans and investments in a community developed financing metric. It will also include an impact and responsiveness review to determine whether community development loans, investments, and services are particularly impactful or responsive to the needs of the community. This could be used to help recognize the importance of certain types of investments, such as affordable housing and community development contributions, such as low-income housing tax credits, LIHTC, and new market tax credit investments. The test will also include a metric for banks with greater than $10 billion to measure the bank's community development investments relative to deposits, a metric which should only positively contribute to the test conclusion. This will also allow examiners to evaluate bank investments under LIHTC and new market tax credit programs. As noted previously, limited purpose banks will be evaluated under this modified community development financing test, which will include an institution's level metrics that measure the bank's volume of activities relative to its capacity. Finally, let me talk about the Community Development Services Test. This new test for large banks will primarily will be primarily qualitative assessment of the bank's community development service activities. Unlike in the proposed rule, volunteer services in all areas must be related to the provision of financial services or expertise of bank, staff, and the community development purpose in order to be considered under this test. The final rule also eliminates a requirement under the proposed rule that would have measured the hours of community development service activities per full-time employee equivalent. Limited purpose banks have the option to have examiners consider community development services activities that would qualify under the community development services test in connection with their evaluation. Finally, although not one of the tests, I wanted to talk a bit about strategic plan. Kris had mentioned this at the outset. This is obviously an important option, and the final rule retains the strategic plan option as an alternative. There are some minor changes, as Kris mentioned. This alternative allows banks of any size to elect to be evaluated under a strategic plan that sets out measurable annual goals for lending, investment, and services activities in order to achieve a satisfactory or outstanding rating. A strategic plan must be developed with community input and approved by the appropriate federal banking regulators. There was some question as to whether the strategic plan option would remain in the final rule, but ultimately was left in by the regulators. That is an important source of evaluation for a number of banks who have chosen this option to tailor it to their particularly unique circumstances or their unique business model. Having gone through the assessment tests, I want to talk a little bit about performance scores and the assigned ratings where the banks are graded for their CRA performance. As noted above, large banks are currently evaluated under the lending, investment, and services test, with the lending test being weighted more heavily than the others in the overall rating of the institution. The final rule revises the process for assigning ratings for a bank's overall performance. For each of the performance tests we discussed above, banks will be assigned one of the following 5 conclusions: outstanding, high satisfactory, low satisfactory, needs to improvement, and substantial noncompliance. The ratings for the various tests will be combined to assign the bank an overall CRA rating, which will be either outstanding, satisfactory, needs to improve, or substantial noncompliance. For small banks evaluated under the small lending test, the agencies will assign one of 4 conclusions: outstanding, satisfactory, needs to improve, or substantial noncompliance. The combination rating will reflect specific weights attributed to each performance test that varies depending upon the size of the particular bank. For large banks, the heaviest weight will be allocated to the retail lending and community development financing tests. Each of those will receive 40% weights, with lower weights attributed to the retail services and products and community development services tests, which will get 10% each. These weights were adjusted from the proposed rule in response to comments that the community development financing test was underweighted. For intermediate banks, tests are weighted equally between the retail lending test and the status quo community development test or community development financing test when selected by the bank. Because limited purpose banks will be solely evaluated under the modified community development financing test, there really is no weighting of their score. As with the prior rule, evidence of discriminatory or illegal credit practices by the bank or its subsidiaries will continue to be factored into a bank's rating. The final rule adds the following to the list of discriminatory or other illegal practices: violations of the prohibition against unfair, deceptive, or abusive acts or practices, violations of the Military Lending Act, and violations of the Service Member Civil Relief Act. The final rule eliminates the proposal that illegal non-credit products also be considered. This was somewhat of a controversial addition in the proposed rule that a number of commentators suggested should be removed, as it had nothing to do with credit practices. It shouldn't be considered in part of the CRA examination or potentially in downgrading an institution's evaluation based upon those practices. In the past, consideration of illegal credit practices has caused certain banks to have their ratings dropped by 1, or in certain limited circumstances, 2 categories. As in the past, regulators will continue to weigh a bank's CRA performance when considering certain applications, including those for branches, openings, mergers, consolidations, acquisitions, relocations of main offices, or other types of tests and transactions under the Bank Merger Act or the Bank Holding Company Act. Notably, an institution with a CR rating below satisfactory could be restricted from engaging in certain activities until its next CRA examination. While the overall CRA ratings available to banks has not changed in the final rule, there remain some concerns that banks may have a more difficult time obtaining an outstanding or satisfactory rating. This concern was expressed by Governor Michelle Bowman in her comment accompanying the final rule. Her view was that based upon changes to the lending test alone, she concluded that nearly 10% of the banks would have been rated needs to improve based upon data from 2018 to 2020. This is substantially higher than it would be under the normal circumstances. Whether the final rule will ultimately have an adverse impact on CRA ratings remains to be seen. With that, let me turn it over to Kerri, who's going to wrap it up with some of the other topics in the rule. Kerri?
Thanks, Jeff. I'll start ahead with the community development categories changes in the final rule. The agencies are taking several steps to more clearly identify the types of activities that will be considered community development. For one, the new rule will identify 11 categories of community development activities. The categories generally resemble types of activities that the agencies have previously determined would support community development, including as identified in previous interagency guidance. I won't list them all here, but the categories include affordable housing, economic development activities, essential community infrastructure, financial literacy, and activities with minority depository institutions, community development financial institutions, women's depository institutions, and low-income credit unions. Another effort the agencies are undertaking to clarify the scope of community development activities is to develop and maintain a public list of example activities that qualify for community development consideration. A third change from the current rule is that the agencies will develop a process through which banks can confirm whether particular activities will be eligible for community development consideration. These changes are intended by the agencies to provide greater clarity and certainty to banks about qualifying activities. I'll move on now to some important changes to the data collection and reporting requirements. Data collection and reporting requirements will not change for small and intermediate banks. For large banks, however, the final rule includes extensive expanded data collection and reporting requirements, with still more requirements for banks with over $10 billion in assets. In response to comments, the final rule leverages existing data collection and reporting requirements where possible. There are several data collection categories in the final rule. These include small business and small farm loan data, automobile loan data if automobile loans are a product line for the bank, home mortgage loan data, retail services and products data, community development loans and community development investments data, community development services data, and deposits data. Certain large banks will also be required to collect, maintain, and report data that would enable the agencies to implement the metrics and benchmarks that will be used in the retail lending test and the community development financing test. The agencies plan to issue data reporting guides and technical assistance materials to assist banks in understanding supervisory expectations. Some key changes from the proposed rule include that banks will only be required to report automobile loan data if the bank is a majority automobile lender or if it opts to have its automobile loans evaluated in the lending test. Another change from the proposed rule is that digital delivery system data collection and maintenance requirements will only apply to banks with more than $10 billion in assets and large banks that do not maintain physical branches. So when will all of these changes become effective? The entire rule will become effective as of April 1st, 2024. However, most definitions, assessment area requirements, and other provisions will become applicable on January 1st, 2026. Reporting requirements will become applicable on January 1st, 2027, with data being reported by April 1st, 2027. The requirements effective April 1st, 2024 include the requirements regarding the delineation of facility-based assessment areas, the public access components of the Community Reinvestment Act rules, and the provisions governing the transition from the current CRA rule to the new rule. So what should banks take away from this nearly 1,500-page rule? The provisions of the final rule that become effective in April 2024 are limited and are the most similar to the current rule. However, banks should still ensure they carefully examine those provisions to determine whether they need to implement any changes in advance of the compliance deadline or see if the new rule provides certain flexibilities banks may want to take advantage of. Banks should also begin the process of comprehending and implementing the much more complex and numerous requirements that will become effective in 2026 and 2027. We expect that most banks will need all the time available to prepare for compliance, especially considering the recent updates to the agency's capital rules that could also have an impact on bank CRA programs. As noted by some of the rule's dissenters, portions of the rule are still unfinished, including the methodology to combine various test benchmarks and metrics into a performance conclusion. The agencies have also committed to issuing substantive guidance on the final rule before the effective date of many of its provisions. The planned guidance includes examination procedures, data reporting guidance, technical assistance materials, templates, and other tools such as data tools developed from reported loan data. Banks should be on the lookout for any updates over the next few months and years. We look forward to continuing to digest this lengthy and complex rule and hope today's podcast has provided some helpful insights. There are other issues and questions that we could discuss today, but we are out of time. Thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. We look forward to you joining us on another Mayor Brown GFM podcast.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.